Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Looks like there was a nice period. There was sort of an anomaly, Stan, in October where the statistical volatility was actually higher than the implied, which is rare, right? Am I looking at that right?
You know, you are looking at that right. They are on the same scale, so that is correct. I think it's happening. I've seen it happen more frequently than you might expect.
Yeah. Wow.
And I think it's very interesting, and I notice that very often, and that's one of the things that I've been stalling trying to get working here, so you could see this more carefully. And here I have the implieds on GLD. I'm having trouble pulling that file right at the moment on the ISE indexes, and I had them all set this afternoon, and I have a little bit of egg on my face, but I do want to try and show you that, and I'll keep trying to pull that while we talk through some of it. Notwithstanding that, the other thing I wanted to come back to on this whole concept of vols is to take a look at what are some of the possibilities on going forward from here. Now, I threw a couple of things in here that are from, not as position recommendations, but just on this idea of, well, if I'm looking at the euros, I'll click back over here. Sorry, wrong spot. If we're looking at euro, and I'm seeing that the volatility, perhaps the volatility is down here. Remember the brown one is VIX. Maybe I am in support on volatility. Maybe volatility picks up again. And again, please don't get carried away with that. That's a scenario just for us to chat over. I took a look at the possibility of higher volatility positions. Now, I used a tool in TradeStation. This is a little hard to see, so if you bear with me, I'm going to push the font. Now, the columns may overlap a little bit, and we don't need to go through this in tremendous detail, but I want to give you a sense of what I was doing. Look, this was brainstorming. I don't know that there's a position in here. Maybe there is. You can consider that. But what I used is a tool that we supply in TradeStation called a position search. It's an options-specific tool. We use it for stock options, index options, and, of course, the Forex options on ISE. And what the search does is allow you to describe a scenario. Here's what I think may happen. Here's a scenario. Given that scenario and my risk tolerance, what options positions might be appealing? That's what the search is about. So be advised, and this is partially by way of disclaimer, but be advised that that's both a contingent on what your expectations are. Most of the time, whatever our market forecast is, even if we're good, it's only so good. But it's also dependent on the modeling. Now, the modeling is pretty well respected, but remember, we're talking about theoretical models. So here's an idea. I took the euro as my underlying using the ISE index. I said, let's take a look at all the strategies that are active market limited risk. So I don't know which way, but one way or the other, and I do want limited risk strategies. And TradeStation boiled that down to straddles, and long straddles, long strangles. I said, give me a holding period up through about a month from now. The 9/11 is a coincidence, with due respect, but the 9/11 was just a month from now. And I said, make believe the price goes nowhere in that month. So I have an expansion in vols, but the price doesn't go anywhere. I said I'll put $1,500 into the trade and assume the volatility has a range 24 to 15, so a little on the higher side from where we are. That's how we ran this out a little bit earlier, and it returned some numbers, no home runs, but it returned some straddles and strangles that are in here. Here's the maximum loss because these are all long straddles and strangles, so it's going to spend as much of that $1,500 as I said, and some modest gains if we're if we're on target in some way. Remember that these gains are averaged based on a range of possible volatility outcomes. We always tell people, like in any financial modeling, don't look at the number here necessarily, but look at this number as being possibly better than this number. They may both be wrong. They're both based on certain expectations and models, but let's take a reasonable chance that this one might have a little better turnout than this one, given that it ranks better. We took that position and then threw it over into our chains window, and then I tossed it into the risk-reward window. Now, what I did in this risk-reward window is something a little different that most people don't do until you get comfortable with options, is I changed the axes. Most of the time when people look at charts like this, they're used to looking at P&L value, let's say, position P&L, and they're used to looking at that over price. So they say, am I making or losing money over price? But I changed this around to volatility. So what I want to see is, how does this position perform as the volatility changes? Now remember, right now we're in this sort of 10, 11, 12 area. We're right about here on volatility. And let me describe what the three plots are. Hopefully, I didn't put too many up. Hopefully we can zero in on it. The blue plot is today. I don't want to show you dialog boxes. I'd rather keep the picture up here, but I will show them to you if you need it. The blue plot is today over vol. So basically, I'm even around today's vol, or I'm out some bid and offer in here. I'm out a little bit on bid and offer. But if you had a big run in vol today, even at the same price, obviously that would help me if I'm long this straddle. So keep in mind, the blue line represents today, current price over a range of vols on the x-axis. And those gets a little thick, so I'm trying to let it sink in as I talk a little bit. Okay. Now, let's take a look at the green line. So the green line is that 1 month from today. It's 9/11. Current price. So this is where I am P&L-wise 1 month from today if the price is exactly unchanged at a range of vols. Now, I hope that's stuck, because what we're saying is, gee, if the price of the euro is exactly flat for a month, but vol kicks up to about 17 and a half, I'm about even. So we always talk about break even in terms of a price. Well, my break even in terms of vol is about 17 and a half. Again, given a passage of a month and the price staying exactly flat. If volatility picks up, maybe not a likely scenario if price is flat, but nonetheless, if volatility picks up, that's where I break even. Now, the magenta line is also 9/11. So the magenta line and the green line are the same date. That's my target date, about a month out. But this assumes that I get a rally. And the price that I plugged in here, I believe, was a 74. And I am going to go back to the dialog box for a minute, because I want to make sure that's what I put in. I put in a 74 price. Now, that 74, again, is based on the ISE index. So if you want to relate that back, that 74, I didn't go quite up that high, is about a 135. Let's see, the 74 is just over 135. Use my little Excel widget. So that 74 is just a fraction over a 135.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.